Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Shares of Netflix, you know that they're dropping. They're down about 8.3%, the most in 2 years. Shares started tumbling last night. The trade continuing lower into today's trade, following a weak forecast for revenue at the company and a warning that the streaming giant will stop reporting subscriber numbers in 2025. You saw that as soon as it crossed last night. You're like, that's a big deal.
It's a really big deal. I mean, less data, that is not something that investors want. It's not something that analysts want. All of that really overshadowing an otherwise strong start to the year. It's best start to a year going all the way back to 2020 and a blockbuster gain in subscribers in the last period. But subscriber gains, Carol, the company said, will be lower this period.
All right, so let's get to the interview. He was a bear on Netflix for years until he wasn't. With us is Michael Pachter, Managing Director and Entertainment Analyst at Wedbush Securities. He's out there in Long Beach, California. Michael, let's just go to it. Down more than 8%, that sell-off, justified in your view?
It is. I mean, I think Tim said something that probably isn't right. As an analyst, I prefer no information. It actually allows it allows me to share my insights, and investors actually value them more.
Well said.
And the truth is, this stock was valued for 20 years on subscriber growth. And that's all people cared about. If you kind of remember, and I know you guys were in grade school, but the dot-com boom, all we cared about was the number of email accounts or the number of users. And that's true of Netflix from 1997 until effectively yesterday. And what the company is now doing is acknowledging that it's no longer a super high growth company, but it is remarkably profitable. And so, we have to transition to looking at them as a low growth company with lots and lots of profit. And I think that what investors are missing today is that the spend on content is likely going to be steady state. There's, if you're spending $17 billion a year on content at 270 million users, do you really need to spend 10% more at 300 million users? No, they have plenty of content. So the leverage from even modest growth is going to be massive, and the cash flow number is going to get giant. So yes, I think it's worth $725. I think the sell-off is overdone, but people are disappointed because they've been trained to value these guys based on subscriber growth.
But Michael, it doesn't sound like you're that disappointed that you're not going to get those subscriber numbers anymore, because you're thinking that this company needs to be valued in a different way.
That's exactly right. And, Harvard Business School wrote a case about my valuation of Netflix. And I've been saying this for 10 years. It wasn't sustainable as a high growth, low profit company. It had to transition to a low growth, immensely profitable company. They started to do that in 2022, and that's when we upgraded, May of 22. And, I said it then, and I'm saying it now. They just had to complete the transition and acknowledge this is how we should look at them. We don't look at Facebook as a high growth user company. We look at it as a high growth profit company. We don't look at Google as, adding users. We don't care at all. We just care that they find better ways to monetize. Netflix has done that. They found better ways to monetize. The two big things are the ad tier, which not only grows revenue through higher, ad revenue per thousand per thousand views, but also allows them to bring in lower income customers, and also allows them to retain people who are churning out. And then the second is password crackdown, no sharing. That means I'm going to pay more when my kids move out. I'm going to buy my kids $7.99 subscriptions rather than make them pay themselves at $15.49. So these two things add a lot of revenue, and that's where we should really start looking at. I mean, we should start thinking about Netflix as growing revenue. Who cares how many users they have?
Let me ask you something, and forgive me because I'm going to go in a tangent, but Tim knows I kind of do this to Apple. Do you feel the same way about Apple, that maybe it's a lower growth company, but it still sells a whole heck of a lot of stuff?
Yeah, I mean, I don't cover Apple. My colleague Dan Ives does, but yes, you sell 500 million or 900 million phones a year. Do do you really care as long as all those people use every app and they're paying in the App Store? Like, you don't care at all. So, the App Store revenue is the part that's really growing, and the warranty revenue, and, all the service income from those guys and all the accessories. So if you have 900 million phones out there, they have more, you can sell 900 million AirPods.
Yeah.
So people start thinking about the basket size. So yes, Amazon, same thing. Do we know how many users Amazon has? We don't care. I mean, I personally went from 1 item a month to 3 items a day delivered from Amazon. And we all are doing that. So we all get it. We understand that Amazon just starts to replace all physical retail, and we don't care if there are more users. Same with Apple. We don't care if there are more users as long as those people buy more.
I love what you're saying. It's interesting, but it's like a total rethink about how we value these companies, or certainly how we report on these companies. Do we get to that point? Is the analyst investment community going to go there at some point?
Well, they're there on every one of the, the big top tech companies, except for Netflix and probably for Tesla and probably for Nvidia. Every other company, Microsoft, like, nobody thinks Microsoft is growing users. They just think Microsoft is growing the way they monetize users. Nobody thinks Amazon is growing users, or Apple, or Google. So no, I think that every large tech company, every $250 billion company or bigger, we should start thinking about them as achieving steady state users, but figuring out how to grow basket size. And that's where Netflix is right now.
Okay, Michael, I want to talk about these different levers that Netflix has to use to increase revenue. I want to talk prices here. I mean, how much room does Netflix have, especially in markets where it's really fully penetrated, like the United States, to actually raise prices?
Well, I think that you're going to see streaming competition kind of drop by the wayside. Let's see what the new owners of Paramount choose to do. Sony's not going to be able to suffer through, big losses on Paramount Plus. And so I don't know yet. Disney is not going to take losses forever. They'll flail for a bit. But as Disney pulls ESPN onto a standalone streaming service, they're going to realize that's a huge mistake. Peacock is unsustainable. So truthfully, I'd say people will probably pay about $20 a month. We're the average user on Netflix consumes 65 hours a month of content. That's worth $20. I mean, that just doesn't turn out to be very expensive, 30 cents an hour. So I think 20 they can get to. I think on the ad tier, they could probably get to something like 6 ads per hour at $40 per thousand. And that means you're talking about $20 or so per month just in ad revenue. So I could see the average revenue going up. And this password sharing crackdown also is going to take that number above 20. So I think $20 per user is, at least in the US and Canada, is pretty realistic. Cut that in half probably for Europe, and then cut it in half again for rest of the world. So again, $20 here, $10 Europe, $5 rest of the world. But I think they're going to get there. I really do, in terms of ad.
You obviously like it. You, as we mentioned, your 12-month price target of $7.25, 30% upside roughly from where we are. What are the problems? What are the risks, though, with the Netflix story? I mean, nothing's ever perfect, except, of course, my co-host. But other than that,
their arrogance is probably their biggest adversary. They don't seem to think that they need the analyst community. So probably half the people who cover the stock could not explain to you what I just explained. They don't have analyst days. They sent out something for the upfront meetings, and they told my team we can send one person. We said, can we send me and my co-analyst? And they said, nope, only one. They're jerks. They don't seem to have any interest in hearing external views about anything they're doing. So their game strategy is just idiotic. And again, a very large shareholder of Netflix told them they should talk to me about games. I was copied on the email introduction, and they never replied. They just don't care. So they think they know everything. You can watch their earnings call. Look at Greg Peters and Ted Sarandos. They are the two smartest people ever born. Like, watch the earnings interview. You can tell they're the smartest people ever born. So they don't need to hear from other people. That's their biggest problem, I think.
Yeah, and some context too. I mean, you have been covering gaming for years too, so perhaps that's why some people recommend that you should talk to those folks about games. I'm wondering if that changes just in the last 30 seconds that we have with you, Michael. Does that change at all now that increasingly you argue they're viewed as a value stock? Will they start to open up a little more?
I don't think so. I think your first point that they're becoming more opaque, this has been their formula for success. They have consistently lowered the number of data points that they provide to investors for the last 15 years. This is their DNA. So no, I don't think so.
All right. So appreciate your time today. Michael, have a great weekend. Michael Pachter, Managing Director and Entertainment Analyst at Wedbush Securities, joining us from Long Beach, California. I'm looking at shares of Netflix. Tim, down about 9% here. So pretty much hovering near their lows of the session, down the most in about 2 years. So certainly one of the laggards we're seeing.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Listen, we're focusing a lot on the equity trade today, but really what we've talked so much about throughout the week, and the reason that we've seen some volatility creep in once again on the side of U.S. stocks and certainly putting pressure, we're seeing that in the week overall, is that what we've seen, Tim, overall this week when it comes to U.S. rates.
U.S. rates have shot higher, Carol. In fact, yields on the 10-year this week, moving to levels not seen this year, all the way going back to November of 2022. So certainly has to do a little bit with the way that people are thinking about the path of the Federal Reserve.
Yeah, exactly. So it's kind of like tick-tock, everybody, because that is the sound of the Federal Reserve basically resetting the clock when it comes to what they want to do with interest rate cuts, putting them off longer, as we know. Chicago Fed Bank President Austin Goolsbee among the latest to weigh in today, saying the U.S. Central Bank, Tim, needs some more time.
Writing about all of this in a week two when we heard from Fed Chair Jay Powell, who confirmed we are indeed, yes, higher for longer. On rates is Bloomberg News Federal Reserve and economics reporter Catarina Saraiva in our Houston bureau. Catarina, a great piece that really ties together kind of everything that we heard this week with Powell, the moves on rates. We know the drill, the Fed data dependent, and yet Fed Chair Jay Powell cementing the message this week that led to the reset of the clock cutting rates, as you write. Why do you think there was a significant shift this week when we heard from a lot of Fed speakers in recent weeks that, yes, that data has indeed come in a little hotter than we like?
Yeah, well, I think, as they say, it ain't over till the fat lady sings. I think in this case, people are really looking for that guidance from the top. And I think especially getting it from the chair is a clear indication that this is kind of, we're now seeing a shift. And it's kind of has broad support. We've, as you mentioned, heard it from various Fed officials, but now also from the chair. And, importantly, we also heard it from the vice chair earlier this week. And you've heard similar sentiments from John Williams, the president of the New York Fed. So that's kind of your FOMC troika, as they like to call it. So, the leadership is saying it, the others are saying it. So now we can be sure that this is kind of the path forward.
It's like in a household, depending upon parents, like one is sometimes more strict. So it's like, well, mom said this or dad said this. Like it just holds different weight. We know that. I'm not saying one sucks to the other.
Who's Jay Powell in this case?
Jay Powell is just, I don't know, he's both, I guess, right? But having said that, it was significant to have him kind of finally get on board with this idea that, yeah, maybe we are going to stay higher for longer. Having said that, I do feel like there's still a little bit of a drumbeat among Fed officials, Catarina, that we're still going to get a rate cut this year. And I feel like market folks that we talk to say, yeah, probably after the elections is kind of what we're thinking. Has a rate cut by the Fed and Fed officials been ruled out completely?
No, I don't think so at all. I think they very much would like to cut rates this year. And they're also concerned about, what will start to happen on the labor market side of things if they keep rates, too high or high for a long time. So they're being very cautious. I think they would like to cut rates. I think you see, this reaction we're seeing in markets is maybe kind of a bit more extreme than where Fed officials are, right? I think you're seeing now just odds of two rate cuts this year, people pushing it out farther and farther. Some banks now saying that, we might not get any rate cuts at all. But I think for the Fed, the latest forecast we have from them is for 3 cuts. That, we'll have to see in June whether that holds up. But I think they want to see a cut.
couple of things that struck me in your story, and this one in particular, because we're starting to hear from people saying, and we have actually for a while, no rate cuts this year, and maybe we get a rate increase. You write in the story, Fed officials are increasingly voicing concern high borrowing costs may not be doing enough work to rein in demand, increasing anxiety among investors and analysts that the central bank may need to actually raise interest rates further. It's interesting how the narrative has changed, I feel like, Catarina, in such a short period of time. What guidance at all or commentary have we gotten really that we can kind of hang our hat on when it comes to Fed officials about a rate increase?
So first of all, it's not that many Fed officials that have kind of opened the door to this, but a few of them have maintained throughout this whole process, from when they started holding rates in July, that another rate increase is not off the table. I mean, you've even heard Powell say this. So I think they want to keep options open. They've seen what can happen when they tie themselves down too much to one policy course, and it's not good. So they want to keep options open, but it's still a very kind of fringe idea, if you want to call it that. It's kind of the last option for them. So I think it's still pretty out there in terms of the chances for that, but they're keeping the door open.
So, okay, keeping the door open, it's fringe, it's sort of an out there option, the way that you described the idea of potentially raising rates this year further. I wonder, though, what data you might have to see for you to start saying that idea is no longer fringe, or we hear from more Fed officials that, okay, we might need to open the door a little wider on this.
Yeah, I mean, I think the inflation data is going to be, really hotly watched from now on. And I mean, it has been already, but I think if we continue to see prints that are disappointing, that are just kind of flatlining or even going up from where we are right now, that's going to really increase concern of that. And then I think other demand activity, right? If you see the easing that we saw in the first few months of this year in financial markets, so if you see, the stock market going up again, maybe treasury yields falling a bit from these higher levels now, that could cause concern. And then some of this consumer data, right? Like the labor market strength, if that just continues unadulterated, if you see consumer spending and retail sales data that continue to come in really strong as it has the past month or so, all of that will kind of add to this picture of the economy isn't slowing as we would like, and it's going to take more action from us being the Fed, not me, but it's that it would take more action from the Fed to really slow things down.
Well, Catarina, we had Matt Boesler on our program yesterday, and he pointed out in a great piece in Bloomberg Businessweek about how increasingly we're starting to see a larger and larger portion of inflation data made up of rents going up, not necessarily across the country, but in certain hotspots around the United States. Given that the Fed's tools that it has are blunt instruments, how does it get that part in control when all it can do is, focus on this dual mandate?
Yeah, I mean, it's a really interesting question. And this is something that Chicago Fed President Austin Goolsbee has been talking about, how if you look at the kind of different big components of inflation, goods, services, and housing, the one that really hasn't slowed down much is housing inflation. And so that's concerning. But as Matt pointed out in his piece, that does have some kind of geographic differences, right? You're seeing slowdowns in the South and in the West, but not in the Northeast. So, I mean, I think for the Fed, what that means is just keeping rates higher for longer or potentially raising rates to try to slow it down. I mean, it is a very blunt instrument. And I think that's why at the beginning of this tightening cycle, people were really concerned that we were going to have to see a recession because demand was just so strong. And in things like the housing market, where you have so many other forces at play, right? We have a huge supply issue in this country. So it's really kind of tough to move that needle when you just have the reality of not enough housing for the number of people we have in this country. So I think if we don't see more progress on that front, it is going to kind of bring back some of those questions about, are we really just going to have to break things a little bit or cause more pain to fully bring down inflation?
Well, and Catarina, as you guys point out, or you point out in your story, I mean, the idea that the things that folks are worried about is that it takes so little to kind of stimulate the economy right now. I think we're all shocked, as growth estimates being kicked higher here in the United States. We heard from the IMF about global growth, and we keep having folks on, especially in the investment universe, are saying like the U.S. is doing well compared to a lot of other markets, especially developed markets around the world, when you look at their economic outlook. So, better growth doesn't take much to stimulate. You got to be worried about sparking inflation again, and that's kind of where the Fed is. And I'm assuming at this point they're going to want to see 2 to 3 to 4, trending lower when it comes to inflation before they're ready to really do something when it cut rates. So that's already, you're talking 3 or 4 months at least from now.
Yeah, I think that's right. And I think that's what we really aim to show in the piece, that the clock has been fully reset now. We've had 3 months, at least with the CPI, of disappointing reads. We're likely to get another kind of flat, maybe up print in the PCE next week. So it really now, the clock is reset. We need another probably 3 months or so of just, data that is where inflation is cooling and not just staying steady or rising.
So, Catarina, let's go back in time a little bit to November, December of this year, when we saw what was referred to, I guess, until yesterday or earlier this week as the first Powell pivot. Do you think that's something that maybe the Fed chair regrets, or perhaps wishes he wouldn't have done?
Yeah, I mean, I don't know. I think it's so difficult to, in hindsight, go back and say that, because the data were looking good. And I mean, to be fair to him, what he said at that point is that, the next policy move is likely a cut,
right,
which I think still seems to be the case.
Yeah.
And really, he was working with what he had at that point, right? So. Right. It's tough.
It's tough. It's going to be interesting. May 1st, that next FOMC meeting, so certainly a focal point for us. Catarina, thank you so much. Catarina Saraiva, Bloomberg News, Federal Reserve and economics reporter.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We do want to get to some of the news that we've been following this week. Just yesterday, Columbia University here in New York calling on the NYPD to intervene on pro-Palestinian protests, resulting in the arrest of more than 100 people. This was according to the FT and also New York City Mayor Eric Adams.
Yeah, this all coming at a time, Carol, when institutions across the U.S. and around the world are dealing with a heightened political climate amid protests over Israel's war in Gaza. And this challenge, just one of the many challenges that leaders of academic institutions are dealing with. Others include the cost of education, how AI and other technologies will change the way teachers teach and students learn, and of course, how to prepare students for a rapidly changing world.
We have one of those leaders with us today. There's a lot on everybody's mind. Francisca Veloso is Dean of INSEAD Business School, which is one of the top business schools in the world, located in France, one of my favorite cities. And Dimitra Kessenides is Bloomberg News Senior Editor. Both of them joining us here in our Bloomberg Interactive Broker
It's not too,
studio.
You can go. Just go. Spend a couple of years at INSEAD.
It might be a little too late.
No.
Having said that, great to have both of you here with us. Francisco, thank you so much for being with us. We love kind of the business school reporting and coverage. It's such an important part of our world. We do have to start, though, with kind of the general macro environment and politics on campus. You've certainly had to deal with it as a leader. What is kind of the role of heads of educational institutions in your view when it comes to protection of academic freedom, diversity of thought, freedom of speech? A wise individual said to me, one of our producers, the freedom to make mistakes, especially as students, happens in a safe environment, an academic environment. That's where we learn and are enlightened. Help me make sense of the challenges you guys are facing in this geopolitical environment.
Good afternoon, and thank you for the invitation to be here to contribute to these important conversations. A lot going on in business schools, as you were saying. I think the key element is exactly what you mentioned about creating a safe, secure, and supported environment for the community, and this has certainly been our focus at INSEAD. And we have one of the most diverse student bodies that you can have. I mean, as we usually say at INSEAD, in your classroom, everybody's a minority, and that's really what it is. I mean, no nationality or ethnicity has more than 10 to 15% of the population. And that has meant that we've worked very hard with our student body to create that environment for dialogue, for understanding. And our students are telling us that that is what's happening. You know, I have been personally meeting with students from different sensitivities, different nationalities, and asking them what's happening on campus. And in our campus, we're having a very positive and productive dialogue. That does not mean that there are no sometimes frictions and tensions, but not in a way that has led to difficulties. On the contrary, the community feels very supported and safe, and that's where we are.
Hey, Dean, I want to take a step back and just explain how INSEAD is different, because I think a lot of people who are listening perhaps are in the US and they're used to what happens in a 2-year MBA program here in the United States, but that's not what you get at INSEAD. No.
So INSEAD has been the pioneer school with a 1-year MBA. And so we've started that many years ago. And we're also a very global school. So we started in France, in Fontainebleau, in the Chateau de Fontainebleau. That's our heritage. But 20 years ago, we opened a campus in Singapore, our Asia campus. And 10 years ago, we opened the campus in Abu Dhabi. And we have now a hub here in San Francisco. And so our school is extremely global. I mean, a third of our activities at the moment are out of Singapore. And this is part of our ethos, because the way we position ourselves is the business school for the world. And that is about the environment that we create at all levels. And certainly as a student, as I was just mentioning, when you embark on our transformative journey, it's super intense in how you engage, but it's also super intense in this human dimension because of this very diverse space that you find. And the fact that we do create this environment means that there is a lot of openness from the students to learn from the others, because one of the things that they marvel from the beginning is that they enter that space and they see, how can I possibly find something in common with such a diverse group? And after a day, they find out that they have many more things in common than they thought. And this is an amazing discovery experience, of course, on the top of the amazing quality of our faculty, the high level delivery that we do. And this is part of that learning experience that they have.
Well, and I wonder, and Dimitra, I want to bring you into this, because I do think about we're in a world where technology can bring people closer, students closer from all over the globe. And there's some interesting reporting that you guys have all done, or Bloomberg News has done, about kind of the role of AI in all of this.
Yeah, I mean, I think AI is really transforming so much. And it's interesting because we went from this place of being terrified when we were first being exposed to some of the more, kind of out there applications of it over the last 2 years. But, in the ways that it'll be used to enable more flexibility and more students from far-flung places to really engage in something, to something as recently as what we reported on this week, which is the ways in which maybe something like AI will be brought to bear in how academic paper and research at business schools will be measured for purposes of accreditation, to see whether or not, to analyze whether or not the story we wrote about was a program that some folks at a school in Philadelphia developed. And it is a way to see, well, are you upholding and really, supporting sustainability measures as set out by the UN. So it's really interesting the ways in which this particular innovation has a role to play. I think Francisco probably has a lot more to say about that, because I know he's focused a lot specifically on technology and innovation. But before I throw it to him, the other interesting point that I don't know if he mentioned, but Singapore is a big campus of theirs, and it's almost as big and significant in size as what's happening in Fontainebleau. So that's a big direction for what's happening in B-school education also, just to underscore that.
Well, it's interesting, and I'm glad you brought that, because it's like that balance right between physical plant, but also what technology can do. Yes. So come on in on that.
I think that this is quite critical, as you said, and it's interesting the point that Dina just made, because we did a recent survey with our alumni. We have, basically 70,000 alums, and we asked them, what do you think about AI? Gen AI in particular, how is that, factoring in? And one thing that's very interesting is that over half of the respondents said that they're actually more excited than concerned. And so this is about, how, is this something that you see as an opportunity or not? And about another 40% said that, they have some concerns, but mostly positive, and only a very small minority thought about these that being something that they're overly concerned. So in fact, I think people that feel empowered in their learning trajectory, in their professional trajectory, I think are seeing these as an interesting opportunity. That's one aspect that I thought I would be highlight. Certainly, we're seeing that from our alumni.
It's nice to hear the positive, because we do get a lot of the horrors potentially.
Exactly, and that's why I was mentioning, because I think it is important to say that in this survey, the majority felt actually very positive about the opportunities.
It's interesting. I had a professor from an institution from Columbia in a discussion recently, and the point was really more, to really get at the fear, you need to, don't think about this as something that's going to come in and replace a job, a position. It's task-based. And as a task-based tool that can transform things, it actually might make your job, it might eliminate your job, but it also might make your job
Why are you
better
looking at me?
and easier.
You're not looking at me, so sorry, Tim.
Sorry.
I'm recording your
job.
It's this idea of
This comes back to also to what we do at the classroom. This is
Thank
quite
you for not
important
looking at
because, business schools really have a very important role to play in this discussion on different dimensions. So first is, of course, to help us all understand what's going on. This is a transformative technology. It's affecting every sector, every business. We need to understand what's going on, what's working, not working, how are people using this technology in a productive way. And that's what a school like INSEAD can do, through the cutting edge research. We have faculty that have been already looking at these even before Gen AI got to the stage that it has now globally. And this is something that we're bringing to the classroom and also bringing to our executive education. We have a very successful program on transforming your business with AI, which is an example of bringing that to the executive population on a more immediate basis, but bringing that to the classroom from the research, which is quite important so that people understand. The second one is make students feel comfortable about using these tools in the classroom as they're going through their learning journey.
Right.
Take the example that Dina mentioned just now. In all dimensions, the university and the business schools has to be a safe environment to experiment, to learn. So if we're not bringing that to the way that we do things with the students, then we're not fulfilling our role as a leading business school.
It is a place to make mistakes. I always feel like education and kind of think through things.
Exactly. And the third thing that I think is quite interesting is actually to think about how you can create new tools, new approach to education itself through these new tools, which is of course something very important because INSEAD we see ourselves as at the cutting edge of business education. So it also means we have to think about how do we use that to create different tools, different approaches in education itself.
So can you talk a little bit about employment after INSEAD? Because no question that is the reason why people go to business school. It's to get jobs that earn more money after going to school, and then also potentially to pivot and switch careers in addition to lifelong networking. But what are the companies, the types of companies that are recruiting at the business school right now? Because I think a lot of people here in the U.S. would say, okay, well, it's consulting companies are huge for schools in New York. Finance, of course, is huge for schools in New York. Increasingly tech in recent years, obviously. But how does that look at INSEAD?
In some dimensions, it's not that different, right? Consulting is a very important part of the outlook for the students that join us. Finance as well, but not to the same extent as the schools in London or New York. That's not to be surprised. And tech is increasingly important. The two aspects that is also quite important for us is an increasing presence of entrepreneurship and the role of entrepreneurship. PitchBook last September did a very interesting ranking of what were the schools globally that were generating more startups over the long run, and basically INSEAD came out fourth globally, our MBA, which was very interesting. Then the other part that's quite substantive on the case of INSEAD is perhaps less on the industry. We have a variety of industries, but more on the geography. The placement of our students is really global. For example, over the last few years, and this is in particular, the number of the Gulf countries overtook London as the most significant placement area for our graduates, because the population that we get is extremely international, extremely mobile. So they look for opportunities in a global scale. And this is one of the things that is super interesting about our population, is how our students really look and say, okay, maybe it's Singapore, maybe it's Malaysia, maybe it's the UAE, or maybe it's London or Paris. And it's in that dimension that I feel there is a very visible difference from some of the, perhaps US-based business schools.
It's significant because I feel like a lot of the reporting is a lot more on the Mideast and the money and the innovation and spending that they are doing right now.
So, Francisco, I mean, here in the U.S., one of the sort of tensions and pressure points in the past year or two, though, on the jobs front has been contraction to some degree. I mean, those are still definitely the leading industries, but there's still a lot of fear and a lot of concern about what we see happening with the consulting jobs, with the finance jobs, certainly with the tech jobs. The layoffs have been continuing. It wasn't just the story for 2023, it was also for 2024. To what extent has that affected your students coming out? And, we did a story last spring, and it was affecting our schools and graduates at the highest levels of the ranking, like Harvard grads all the way on down, who were graduating without jobs and feeling very nervous.
And we just have about 45 seconds.
Yes. And it is also having some impact because, of course, there's less opportunities on these, and so which means that our students are finding also other opportunities as well, because we're seeing just less jobs available in those industries. So they're doing these two dimensions. One is the geographical element. So perhaps they're interested in consulting, and they say, okay, if you want consulting, you may have a good opportunity in the Middle East, but not in London, for example, or in New York. The other part is to look at other industries. And for example, a big push that we've had over the last few years to look at sustainability and to look at the energy transition. We're also very much supporting our graduates to explore these other aspects of the role that business schools can have, to explore these new opportunities in terms of, for example, energy transition, sustainability, and all of these elements that are picking up around the globe, and where we feel that we are training our graduates to lead on that, and very much interested to be and to continue to be at the forefront of this.
Interesting time to be leading a top business school. It's got to be fun. Dean Francisco Veloso of the INSEAD Business School joining us here in studio, along with our own Dimitra Kessenides, senior editor at Bloomberg News. Thanks to both of you. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session. Getting ready to wrap up the Friday trade, also the week overall, a week where we know it's a trend line, not great one for the S&P 500. We would be down 3 weeks in a row. Haven't seen this in some time, but it's okay if you're trying to be a bear in this market. But if you're got some bullish overtones in your portfolio, that makes it a little bit more tricky.
Yeah, worth also noting that the yield on the 10-year hit its highest since November over the Fed reset. This idea that the Fed's resetting the clock and on cuts and reevaluating the trajectory of price growth. And we've got a great guest to help us, get an idea of really what's going on and make sense of rates plus equities as well. Janet Rilling is senior portfolio manager and head of the plus fixed income team at Allspring Global Investments. She joins us from Wisconsin. Janet, how are you?
I'm good. Good afternoon.
Yeah, good afternoon to you as well. I do want to start with what happened with yields this week, because we certainly saw a reset from the Federal Reserve, and I think that expectation is certainly playing out when it comes to the rates market.
Yeah, so this is really the data dependency playing out, right? The Fed has told us they're going to be data dependent, and when we see the data change, they're going to change. So what have we seen happen? We've seen stronger growth than expectations, a more robust job market, but most importantly, elevated inflation. And that's what's caused them to make a change in their view. They've been communicating a more hawkish tone. Powell earlier this week indicated a shift in that view, and that certainly has resonated in the fixed income markets.
All right, speaking of shifts and tones, we're just watching shares of Nvidia right now, extending their drop to 10% right now as we speak. So they're erasing about $212 billion in market cap value when it comes to Nvidia. So again, this has been, one of the standout performers, best performing name in the S&P 500 last year. It was another top performer already this year. I mean, the stock perspective, everybody, it's up about 53% this year, but we are definitely seeing a very different tone in today's trade.
Nvidia goes down also?
Stocks go up, stocks go down, but it's interesting. I'm just going to pull up real quickly on the Bloomberg, a GP chart, and in terms of the trend line, like you've seen a little bit of a rollover here. Yeah. Certainly if you go back to when it peaked kind of back in late March, so you've definitely seen a move down and definitely a move down lower in today, again, extending the drop to 10%. So we talk about corrections.
Well, likely we'll see it move, fall or close below, Carol, its 50-day moving average for the first time, going all the way back to November.
Yeah, so this is why we care about what's going on. These are names that have been really propelling some of the momentum in the markets. All right, back to, though, what's also been propelling and changing the momentum, and is that move up in rates. Going back to Janet Rilling, who's over at Allspring Global Investments. She's head of the Plus fixed income team. So I am curious, Janet, we've talked about, the changing narrative from the Federal Reserve and the changing narrative around U.S. Treasury rates and what we've seen along the Treasury curve. When is it that you guys pull the levers for your investors saying, now it's time to kind of change our strategy on the fixed income side of things? Is now the time, or did you do it already, I don't know, a month ago? I'm just curious.
Yeah, we're certainly a team that's active in rates positioning. Last year, we had a long duration position on, given our expectations that we were at the terminal rate by the Fed. We did neutralize that coming into this year, so that puts us in a good position to be opportunistic with the changes in rates. Earlier this week, we saw the 2-year briefly go above 5%, and I would say that was a point we thought it was worth nibbling a little bit. So we are watching closely and watching for an opportunity to add duration if there's continued upward pressure here on rates.
What would prompt you to add to the portfolio right now? What would prompt you to buy? What do you need to see on the rates curve?
Yeah, well, part of it is just outright levels. If we start getting above 5% on the 2-year, that's looking pretty attractive to us. While the Fed has turned a bit more hawkish, we are not expecting them to raise rates, particularly in the next several quarters. So a 2-year above 5% seems like good value to us, where we can start collecting that yield, and there's not the pressure of it going up much further.
But when you say about adding duration, how far out on the curve are you willing to go, and does it make sense? I'm just thinking for investors, especially, I don't guess if they are thinking about, almost 5% on the 10-year. If we go back there, I mean, how many are saying, this isn't a bad shift in my money and a way to kind of lock in an expected return, if you will, with maybe less risk than we might see on the equity side of things or some other investments?
We are more constructive on the front end. So a place we are overweight is the 5-year. More in the 10-year space, we're more neutral. And as we go out further in the 30-year, we do have an underweight position because we think the range of outcomes there is much wider. You have issues with if inflation does accelerate further, the long end will be hit a bit further. And certainly there are some technical pressures related to funding for the government for the ongoing deficits that we are running.
What do you think we could top out, or where could we go above on the 10-year?
Well, certainly earlier or late last year, we hit 5%. And
right.
So certainly we could retest that 5% area. But our base case puts it probably a bit below 5%. I mean, currently today we're at 461. I think we hit about a 464 earlier in the week. I mean, there's certainly room for it to move up some from here. But given our outlook, we would think that 5% would be a good place to start adding.
Sorry, 5% on the 2-year or the 10?
10.
On the 10-year.
I mean, that's interesting because we've spoken to a lot of folks who said, within this cycle, we think we're not going to hit 5 again. We think that the peak happened back in October. What say you?
But you think it'll be below 5%. You'll think it's more likely.
Yeah, our base case is below. My point was if we do retouch 5%, that could be a buying opportunity.
Okay.
Beyond the U.S. Treasury curve, where else in fixed income do you find the best opportunities right now in this environment?
Yeah, we think it's a good time to be diversified in your exposures. So we run a Core Plus strategy where we can use a lot of the global fixed income sectors. So we do have an allocation to investment grade corporate credit. It's more of a neutral allocation, but we think it's a good place to be, particularly the BBB part of the investment grade credit space. You get a bit higher yields there. And with the strength we've seen in the US economy, we think that those companies will be stable and able to continue to service their debt well. In terms of high yield, here we're at the lower end of our range in terms of our allocation. We've kept some dry powder in the event that we get more of a risk-off trade. And certainly this week with what we've seen in the Treasury market, we have seen high yield spreads widen. So that opportunity could be coming in the next couple of weeks. The fundamentals are quite good in the high yield market, but of course valuations reflect a lot of that right now.
Hey, Janet, we're going to have to leave it there. Thank you so much for joining us this afternoon. That's Janet Rilling, Senior Portfolio Manager and Head of the Plus Fixed Income team over at Allspring Global Investments.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.